Hi everybody, CapitaLand Escort Trust Q1 2023 have made 59% profit compared to Q1 2022. The world travel has resumed, and is there any further growth potential for CapitaLand Escort Trust? Let us take a look on it. CapitaLand Escort Trust is the largest lodging trust in the Asia Pacific region, as it has more than 100 properties globally, where it comprises of more than 18,000 units. And when it comes to hospitality trust, most people have the perception of hotel or even service apartment. But for CapitaLand Escort Trust, it has a very diversified portfolio that gives him a balanced mix of income. So from this side, you can see that it has 56 service residents, 18 hotel or business hotel, and 21 rental housing, and 9 student accommodations. And rental housing and the student accommodation currently make up about 18% of their portfolio value. And CapitaLand Escort Trust is still mainly Asia focused, where 60% of their assets are in Asia. Why I say there's a mix of income stream, as from all these 100 over properties, there are different contracts. 32 are on master leases, 8 of them are on management contract with minimum guarantee, and 63 are on management contracts. So when talk about stability of income, master lease and management contract guarantee income, it gives a form of stable income for the trust. And management contract, which they call it a growth income, will actually couple with the income will be variable, but will couple on the performance of the properties. And as the world is reopening and many people start to travel, and management contract will give them the upside for that. So for their Q1 2023, where they have announced they have a gross profit that grows by 59% year on year. And from this table, we can see that actually 59% are from the stable income, which is the master lease and the management contract with guarantee, and 41% are from the growth income. In general, CapitaLand Escort Trust portfolio will be usually a 50% mix of stable income and 50% mix of growth income. But however, for Q1 usually is a lower period for traveler, and which is why the stable income have make up a bigger percentage. This is a FY 2022 performance, where we can see that the master lease comprise of 31% of their gross profit, and management contract with minimum guarantee comprise about 11%, while the management contract, which is the growth income, comprise of 58%. As the travel have resumed, this is why the management contract is on the higher side. But long-term side, the risk is striving for a 50-50 balance approach. For Q1 2023, we can see that the RevPAR of CLAS, we call the class key market, have actually increased by double digit, and some of them is even triple digit. For example, like Australia, Singapore, and Japan have increased by 351%, as Japan have opened up later part of last year. But from here, we have see that China actually, the growth is still very low, 16%, as China have just ended their zero COVID policy late last year, and they are just slowly start to reopen, and we may see a potential growth of RevPAR for China market going forward in FY 2023. The balance sheets of CapitaLand Escort Trust remain strong. We look at the gearing is 38.7%, which is within a healthy range, and the interest cover is 4.4 times, which is very healthy, way above the MAS requirement of 2.5 times, and also compared to some of the competitor, which their interest cover ratio is on the low side. Currently, with the high interest rate environment, we have no sign of when interest rate will stop hiking. We will prefer a REIT to have more of their debt on the fixed rates rather than more on the variable rate. And CapitaLand Escort Trust currently have 75% of their rates that are on fixed rate, and they have a good average year to maturity of 3.9 years. And for this year, 2023, they have about 14% of their debt that need to refinance, which in general is on the low side, as I prefer to be less than 20% for a REIT. CapitaLand, the 100 over property are scattered around the world, so definitely there will be some foreign exchange risk. And one thing about them is they have actually hedged their forex risk, and the impact of forex exchange in their gross profit is actually less than 0.1%. So it's pretty negligible on that. So we look at their FY 2022, which end at 31st of December. We have seen that their DPS, their distribution per staple security, have increased over the past 3 years from FY 2020, FY 2021, FY 2022. There is a double-digit increase in their DPS year on year. And the next question you may want to ask, would they able to repeat this type of double-digit growth in FY 2023? And one thing to note that this double-digit growth of DPS over the past 3 years is that as FY 2020 is the COVID year, and thus their DPS has actually dropped drastically, and actually they have grown from a low base up, which is why you can see a double-digit year-on-year growth on the DPS. And let's look at a longer time spectrum for the past 5 years, pre-COVID and post-COVID. We look at their DPS before COVID at 2018, actually is 7.18, and increased to 7.61. But during the COVID year, as we know that hospitality trust is one of the badly affected trusts as the whole world can't travel, and thus their DPS have dropped by more than 50% from their 2019. Thus they have on a path to recovery. However, we have seen that they have not really fully recovered yet to their pre-COVID level of their DPS. Although their revenues and their profit have actually exceeded the 2019 level, but because of the bigger base, thus their DPS is still about 2 cents below their pre-COVID level. To me, that is another potential upside for CapitaLand Ascott Trust to further grow their DPS as the world traveling has started to resume and more people have started to travel around, and also China has started to open up. And let's look at their financial ratio. In general, the aggregate gearing actually had crept up slightly to 38% compared to their pre-COVID years. Nevertheless, it is still in the very healthy range, and their interest cover ratios have improved from the low of 2.7 to 4.4. I hope that they can improve further more to become the pre-COVID year of a 5.8. The adjusted interest cover actually have improved from a 2.0 to 3.6 and very close to the pre-COVID year of 3.9. Let's look at the share price performance for CapitaLand Ascott Trust class. In short, for the past 1 year, the trust have outperformed the REITs index by about a 10% margin. But however, in general, majority of the REITs have underperformed the STI due to the rising interest rate environment, and people are concerned about REITs borrowing and refinancing matters. If we are to put in the total return, including the dividend, you can see that actually for the past 1 year, CapitaLand Ascott Trust return is flat compared to the REITs index total return, which is down about 9%. So these trusts have actually outperformed the REITs index for the past 1 year. Let's look at a longer term perspective. Let's look at pre-COVID and to now for 5 years time horizon. The performance of this trust is actually slightly better than the REITs index and even also the STI index by a small margin. And we know that this trust have IPO before the global financial crisis and have been listed for more than 15 years. And the long-term performance is not really that attractive, where its return is slight negative, about 1.12% compared to STI, which is actually up 30%. So what does it mean? It means that you happen to buy this REITs at the IPO period and you hold until today, you don't make any capital gain. The gain you collected is mainly only on the dividends. So let's look at, if we were to couple in the dividend, then the total returns since IPO, it actually delivered a 184% return, total returns. To me, this is not a very impressive track record compared to some of the top performance REITs listed in SGX. However, it is still performed better than quite a number of REITs listed in SGX, where some of them can give you negative return even after you invested for more than 10 years. And because of the nature of this trust, where invest mainly on the hospitality sectors, there will be some volatility in it. And especially in the past, where their focus is mainly on hotel and service apartment, where you will be affected by season, by economy, and thus this trust have started to go on a transformation path to build more stable income so that they can withstand that market fluctuation, just like what happened to COVID, and also to reduce the impact of seasonal basis. So they are embarking on building a source of resilient, stable income. The first source of income will definitely come from the master lease side, where they will have a fixed income. And also they're looking at longer stay property. As we know that when you stay in a hotel, maybe you only stay 3 to 5 days. A service apartment, maybe I expect come or maybe say 6 months to 1 year. But if for rental housing and student accommodation, the person staying there maybe stay there for years. Like went to university, may stay for 3 years. So this will create a more form of stable income. And then they also try to have another income called the management contract with minimum guarantee. And this is mainly on the service apartment side where they will have a minimum guarantee income. So this will form a form of stable income for this trust. And thus, as an investor, you will able to achieve a more stable dividend rather than a more volatile dividend on a year-on-year basis. And on the growth side, and we know that the world will open up and we can see that all the key markets have a double-digit or even a triple-digit growth in their RevPAR. However, there's one market that is just started to open, which is China, where Chinese travelers have actually not really flooded the world yet. This will be another catalyst for the class to grow. Also, as an investor, you need to take note that those double-digit growth from the key market, even a triple-digit growth, we should not expect them to be a high double-digit or triple-digit growth. And for the past FY 2022, we have seen that most of the REITs have stopped acquiring properties due to the high interest rate environment and due to the volatility of the market. But class have continued to buy property for FY 2022, but the main purchase are mainly towards the last quarter of FY 2022. And the 15 property that purchased, majority of them are more towards the stable income side, where you can see they have purchased student accommodation and various rental housing in Japan. This will further help to build up their stable income portfolio, where they are embarking on long-term growth to build their stable income base for long-stay accommodation to 25 to 30%. Currently, the long-term stay is still less than 20%, and they will still remain predominantly focused in Asia Pacific in the near term. Another positive catalyst for class is that March this year, they replaced Golden Agri as an STI reserve list. This may make them as a potential of a STI listed stock. But however, do bear in mind that although they are on a STI reserve list, but in terms of size and market cap, they are still smaller than some of the REITs listed like Fraser Centrepoint and Suntec REITs. We should not have a high expectation they will be the next one to be in the STI component stocks. But putting in a reserve list, I show that these trusts actually have grown over time. Another key thing to take note of this is that the sponsor, which is CapitaLand Invest, have announced early this year they're going to give a one-off special dividend in specie. For every one shares CapitaLand investor have, you'll get 0.057 class unit, which is valued at 5.9 cents. This will reduce the sponsor stake to below 30%, which to me is still a very, very healthy range. CapitaLand Investment, by doing this action, you'll reduce their stake in class from 37.53% to less than 30%. But to me, it is still a very healthy weightage for a sponsor, which is still above 20%. It will further enhance the liquidity of class, but it may also create more volatility when this dividend in specie is issued, and most likely they may issue in May or later part of Q2. In general, I feel that there is still a potential growth of DPS for CLAS as the whole world is opening up, and with the growth of DPS, it may provide a further capital upside for CLAS in the near term, as the DPS have not go back to the pre-COVID level yet. In conclusion, I feel that there is still some further potential upside for class, as their DPS have not restored back to their pre-COVID level yet, and world traveling has just started to pick up and have not go back to the pre-pandemic level yet. However, class is still on a transformation path where they're going to build more stable income to long stay asset to further stable their distribution, and this will not happen overnight. It will take some time to do it, and along the way there may be certain form of equity fundraising required for class to further grow. Thus, at this juncture, I'll take class more as a tactical investment rather than a long-term whole investment based on their track records and also based on their transformation process, as the transformation will take time to come and see result. By then, I may reconsider my view on class. To me, it is a very well-managed risk from how these risks have survived through the COVID, and I'm actually looking forward for the future upside potential growth on this. That's all I have to share with you today, and if you feel that if this video has benefited you, Do remember to like, share, and leave your comment below. Do remember to subscribe and press the notification button so you'll be notified on my next video. I shall see you in my next video. Bye bye.